There are signs of exuberance and even more so lottery seeking everywhere you look. So we measure a dispersion, the spread in different securities, which give you a sign of how noisy it is, how much dislocation there might be going on. We measure that across a range of global markets. It is very high in US small caps, but it is not just US small caps where you're seeing high dispersion. We're seeing it across emerging markets, particularly in China. You're seeing high dispersion in Europe, and you're seeing within that signs of genuine lottery seeking. So people looking for and buying more volatile, more risky stocks. I call them lottery stocks. It's, because it's the chance of a big payout, a big rise up. And you're also seeing it in other markets, like the options markets, where we're seeing a lot of call option buying. Structurally, the closest thing you can perhaps get to a true lottery in financial markets is a far out of the money call option, small premium, chance of a big win. And I think that's something that is not just a US phenomenon, not just a global phenomena, and not just an equity phenomena. I think you were probably talking about it earlier, the signs in the crypto markets, the signs all over the place of a real enthusiasm for risky stocks. Now, does that show that we're at the top of the bubble? Absolutely not. As we know, bubbles can continue to inflate for a long time after everyone realized that that we're in a bubble. Does it show that we're in a bubble? I think it is fascinating that we are seeing all sorts of signs that we're in a market, the likes of which we haven't seen precisely, since the late 90s, very early 2000s.
Bad news for you, isn't it, since you're head of index investment? Because once we get to this point where valuations look very ripe, you tend to look for individual stocks that have lagged behind to outperform, rather than trying to buy indices that have come a long way already.
Yeah, it's true. I mean, we're in the sort of part of the year where traditionally every year around this time we'll get news articles saying, finally, this is the year for active management. This is the year for stock pickers. And I think as someone who works for an index company and looks at the markets, it's important for me to say, when we see it, this does look like a stock pickers market. There's huge differences in sectors, huge difference in stocks. Plenty of opportunity for skilled investors to monetize their insights and their skill. Of course, the flip side of that, and why you might not necessarily want to immediately start concentrating in individual stocks, is first of all, the more noisy it gets, the bigger an advantage you get to diversification. We've seen huge movements under the hood across the world, but actually we haven't yet seen much volatility in the top level indices, not in the S&P 500, for example. And that's because of that diversification effect. So, the advantage of all this noise under the hood is that a diversified investor doesn't have to suffer all that excitement. The other thing is it hasn't got any easier overall. GameStop is it's an extraordinary story. It's still a very, very small part of the overall market. And this still is a market today which is dominated by professionals. So you don't just need to be smart, you need to be smarter than average in order to outperform. The average is still very, very smart indeed.